This is a FarmDoc daily webinar. I'm University of Illinois Extension's Todd Gleason. We're joined today by Brad Zwilling. He's the Vice President of Data Analysis for the Illinois FBFM. That's the Farm Business Farm Management Association here in the state of Illinois. Thank you, Brad, for being with us to present machinery investments and farm financial trends for the FarmDoc team. I appreciate you taking the time with us today. I bet you have a lot to discuss, so I'm going to let you kick us off.
Well, thank you, Todd. Yeah, we're going to look at machinery investments and see the impacts of those, and then look at some trends in some of the balance sheets items that we have, and talk a little bit about deferred taxes, and we'll answer some questions along the way as well. So first, we're going to look at average machinery values, and they've per acre, and they've doubled in the last in 7 years on this sheet. And when you look at this, is we started out about $250 an acre and ran up to 2007 about $300 an acre. And then in 2014, we moved to $600 an acre, and that's where we see that doubling effect in 7 years. And we know that's when they had the run up in ethanol prices, impact of our grain prices. And then we kind of leveled off there from 2014 to 2020. And then in 2021, we were at $603 per acre. And this is the average machinery value of Illinois FBFM grain farms. So let's look and see, one of those components of that would be the machinery purchases we're making. And we talk about machinery purchases, we're just talking about the combines, the tractors, the implements that we're using on the farms. And those have almost increased 400% since 2003. We started about 14, and I'm looking at on a per acre basis. We started at $14 an acre in 2003. Those stayed about the same until that 2007 period of time. They went to $20. And then we moved up to 2013 at $50 an acre. So there's a range there of an increase. Came back down as we saw in the values as well. And then in the last 4 years, we've seen that jump up, and then had the highest at $67 per acre in 2021. So with all that, what's the impact then on some of the purchases of the machinery values? So we look at that. We've taken the total machinery values over that same period of time and added in the orange piece, which is the machinery value purchase minus any sales that would have happened as well, because that would bring down that machinery value. And we started at $12 an acre. That's that difference in 2003. So a little different. That was 14 on the slide before. We go up to 12 in 2006, and then up to $46 in 2013. We look through those different periods of time, and then it kind of comes down again as well, and then up to $43 in 2021. So a huge increase there. About 8% in 2013 was from the machinery purchase of that value, and it was 7% in 2021. So about 5 to 7% of the total machinery value is the purchase, the new dollars that we're spending to add to that value. Now, what else is going on that maybe has a driving impact on machinery values and our purchases? So let's look at Irs Tax Effects. So we have what's called the expense election, or the 179 election. This allows a producer to purchase a piece of equipment, and they're allowed to deduct a portion of that as a current cash expense and then depreciate the balance of that over time. We also have what's called bonus depreciation. Bonus depreciation allows you to take a purchase and deduct portion of it in current year and then depreciate the rest over time. And those percentages that we've seen over this last 18 years is 30%, 50%, 100%. And there was a few years that we had no percent that you could deduct with bonus depreciation. Keep in mind that we've also got just regular depreciation that happens, which is about 10.71% for some of our purchases in a current year anyway. And then we've got something to think about is purchases used as a cash expense. With these new tools that IRS has allowed us to have, more and more farmers are using a machinery purchase maybe at the end of the year instead of buying more seed or fertilizer as a cash expense, instead of depreciating over the useful life of that asset. One other big driving factor came at the end of 2017, and machinery is no longer be able to use like a like-kind exchange. And basically what that means is, before you would just show the boot or the net effect, the new dollars you paid when you traded in a piece of equipment as your purchase cost. Right now, since 2017, you show the sale of a tractor. Let's say it was $50,000, and then you purchased a new tractor for $200,000. So you show both of those on the tax return. Prior to 2018, you would have showed a $150,000 purchase. And this is all part of the Tax Cut and Jobs Act that passed in 2017. So let's take a look at these and see what they've done over the period of time that we're looking at. So IRS expense election over this period of time. So we look at 2003 to 2007. We had and this is in 100,000. So this is $100,000 from 2003 to 2007. It jumps up a little bit each year. They had different tax law changes that changed that. And then in 2008, we jumped from 125,000 in 2007 to 250,000. So that's why we have orange bars. We had 250,000 in 2008 and 2009. The blue bars are our $100,000 ranges. We had another tax law change in 2009, 2010 that moved us up to $500,000 of expense election. And that goes from 2010 to 2017. That's the green. And then finally in 2018, the pink area, they raised that all the way up to $1 million. And now that's set to adjust for inflation each year. And we already know that 2022 will be $1,080,000. With the expense election, not only is the amount of dollars that you can take in the expense election adjusted for inflation, but so is the phase out amount. So the phase out amount is $2.5 million. So if I buy over $2.5 million of equipment adjusted for inflation each year, then I can't use the expense election. So those are some things to keep in mind. These are the different bars of time that we saw the different levels of expense election. So we had basically 4 different areas or groups of expense election in the last 18 years. Now we're going to take that same graph we just looked at, and that's the top part of this slide. And at the bottom part, we brought back those machinery purchase per acre and see if we can kind of correlate any of those. And we look at that blue section, we see that that was about the same. We were about $14 to $20 an acre from 2003 to 2007. So those were all about the same. We do see a jump up of $10 an acre in 2008 and 2009, and that's when we jumped $150 to $1,000 expense election. And then in the green bars, we see that those 500,000 doesn't seem like it made a big impact in that first year in 2010. We do see that it went up in 2011 through 13, but then came back down. So just initially looking at that, I don't think that had a huge impact. I mean, allowing them to use that gave that option, but maybe not the reason why we purchased those. And then those last 4 years, we have the pink area, and you can see those have jumped up quite a bit. One thing to remember, we talked about that 1031 going away in 2017. And so in those cases there, we're showing the full purchase price in 2018 through 2021. It's hard to tell what exactly those numbers would have been, but from the past experience, the people that just sold equipment was about $2 to $3 an acre. So if we subtracted out the purchases, subtracted out the sales and added back $2 to $3 on each one of those, we would be more like the 20s to 30s, which is closer to that green range that we had from 18 to 19. And then 2021 is really hard to gauge because the values have gone up. So probably when they sold equipment, it's more like $5 to $7 an acre. So that 67 really maybe could have been $45 to $50 an acre if you looked at those that adjustment. But it's hard to tell. So just something else to think about when you look at those expense selection, the impact. But I don't see huge increases when we went to $1 million in machinery purchases per acre. So let's look at bonus depreciation, where it's been over that period of time, and then we'll look at the impact of that as well. This graph is a little hard to follow, but watch the left-hand side. We look at the 30% is the dark orange. We had that in 2003, and then halfway through the year, we changed to 50%, and we had that in the rest of that year, and then in 2004. Then from 2005 to 2007, we weren't allowed to use any bonus depreciation. It was not available. And then in 2008, they had a tax law change that brought that back through halfway through 2010. And then in 2011, we brought back 100% bonus for 2 years in 2010 and 2011. And then in 2012, we went back to 50% through 2017. And in the middle of the year, we changed that back to 100%. And we've had that all the way through 2023. And after that, 2022. And then we start phasing that down 20% each year till it goes all the way gone in 2027 with current tax law. So in 2023, next year, we'll only get 80%. The big piece where bonus depreciation comes in is it doesn't have the limits like the expense selection. So if you have negative income, you still can take bonus depreciation. If I'm a cash rent landlord, I can take the bonus depreciation on my tile. Also, what else the bonus depreciation can be used for is if I'm over that limit, there is no limit on the amount of purchases, so I can use bonus depreciation. So it comes into play. The other big piece is bonus depreciation is used on is buildings. Anything with a life of 15 years or more, bonus depreciation is typically used for. So you'll see some things on some building slides we have later that may correspond with that. So I kind of want to compare the two different tax aspects that we have, or tools that we have, with the expense selection at the top and the bonus depreciation at the bottom. So you can see the different tools that are available to us. So there was those first years where we had only 100,000 expense selection. We had a little bit of bonus during that time. We increased that bonus depreciation in 8 and 9 and more of those expense selection. And then over the other periods of time, we've had about the same. We've had a lot of expenses that we could deduct as a current cash expense. And then seeing that even though we're phasing out of our bonus depreciation starting in 2023, our expense selection is still going to be $1 million and adjusted for inflation going forward. And remember that we have $1,080,000 starting in for 2022. So we really didn't see a lot of impact from those two tax tools. I think the bigger piece is looking at income, and that goes back to where we're using purchases as a cash expense. I think this had a bigger impact on that as well. Plus, there's more cash available to buy new equipment or replace equipment. So if you look at the top green line, that's the accrual net farm income for each one of those years per acre. And when I say accrual, what I'm meaning is that we're valuing the change in inventory and then taking out any prepaid for fertilizer, seeds, and chemicals and putting them to the correct crop year they would go into. So as you notice, as we look through those income years, see that the high at 227, that would have been in 2012. We see that increase really didn't happen to 2013. That was the high year in our capital purchases at $50 an acre. And then we see as our incomes came down, that's also why we saw the decrease in some of the purchases. We went down to that $24 in 2015 after a lower year in 2014. And those continue to go down to those very volatile years. They went down to zero and then back up to a couple $100 an acre. And finally, 2019, we've gone up to $216 an acre from an accrual basis. And then we can see why our 2021 purchases went up. And I foresee that our 2021 purchases could be up as well after all the records come in. But it's hard to tell because if they had to be able to purchase those equipment, more and more were hard to find used equipment. So it'll be interesting to see what 2022 brings. So we've taken those, we've talked a little bit, all those were averages. And now we're going to talk a little bit more on just so you can kind of figure out where am I at? And I'm looking at the last 10 years and how that's shifted over time. So the bottom lighter blue line is what the graph looked like in 2011. And then the dark blue, the 2020, is the 2021. And we can see there was quite a bit of shift at the higher end of number of acres. In 2011, it was about $500,000 of equipment on the farm, and for a 1,000-acre grain farm. And in 2021, it was about $600,000. So not much change there. But if you go all the way up to $3,000 an acre, that's about $1.4 million of equipment needed for that operation. And if we look at 2021, that moves up to about $1.9 million. So a $500,000 increase or 36% increase. And if we go out to the far right-hand side, we're seeing about a $1.1 million increase from the 2011 to 2021 at that 5,000 acre line. So 61%. So those larger acre farms, and this graph continues out to the side, as you go at larger, that trend's going to continue up to a certain point as where you have to add another combine or another tractor or another planter. As those changes affect, that graph's going to squeeze in and come back out as well. So this is interesting to look at. It kind of gives a way to benchmark. And these are for all Illinois FBFM grain farms. And then the total acres farmed would be the bottom number of the graph that we're looking at. So some interesting pieces to see and kind of an idea of what we've saw already on the average farm, the huge increase we've seen over time. We see that shift, that the more acres you have, the larger percent increase you recognized. The next slide takes the same kind of information and puts on a per acre basis. And we look at the increase of about 40 to 60% from 2011 to 2021. So as a per acre basis, that not much difference whether you're a 1,000-acre farm or a 5,000-acre farm. It's all about the same. About that $200 an acre difference from 2011 to 2021. So that same kind of shift happens on those, but as you notice, the dollars per acre go down as you farm more acres, which makes more sense. You got a little bit of economies of scale going on in those standpoints. And you see that at the very beginning of that graph, you get those steep curves. And some of that's the driving factor of, one combine is going to be pretty hard to justify to farm a couple hundred acres. So that's where you see some of that, or a larger planter, or whatever those pieces of equipment are. That's why you see that big skew down at the top. Okay, so we talked about what machinery values are done. Let's talk about what's going into that. What are the items that farmers are buying, and when are they buying them? So when we look at machinery, once again, that's the tractors, the combines, those pieces. What are the most dollars spent on by the different types? So in this graph, we have the bottom line, which is the most. That's tractors, and they've been about 25 to 26% over the last 18 years. That makes sense. We have quite a bit of those, our power pieces of equipment on our farms. So that's what's the driving factor of that. And then in the middle, we have planters are about 7%. And then heavy general purpose trucks. So that's your pickup trucks, your half-ton, three-quarter-ton trucks, and even some straight grain trucks would be in there. So that's 10%. And then combine heads. So that's the draper heads. That's the corn heads. Those are about 5 to 6%. There's growing in there. You can see what the value of those in. And I think some of that is the implementation of using more draper heads, a little bit more expense in those heads. And then finally, the second largest expense would be in the combines, which makes sense. That's the high purchase value that we have on those items for our farm. And those have gone anywhere from 17% up to the mid 20%. So out of total dollars spent on the farm for capital purchases, we spend quite a bit on combines and tractors, which makes sense. Those are the most expensive items, but it's kind of nice to see and understand that. And so you're looking at about 40 to 45% that's invested in the combine and tractors out of the dollars that we spend. So we also look at buildings. So I know this is talking about machinery, but let's talk about buildings. And farm buildings is going to be tiles. Those are going to be the more permanent structures that are kind of tied to the real estate or tied to those items that are going to be part of the real estate. That's where the grain bin equipment come from. That may be a dryer or some heavy pieces of equipment that are there. So we've got the tiling is the biggest piece. That's about 30 to up to 40% of that value of those purchases or total values we're buying. And then grain bins, machine sheds, and then grain bin equipment is other small pieces of that. And then finally, everything else. It might be a dairy barn. It might be a hog barn. Those are what everything else would be in those percentages. But it's kind of interesting to see that tile, which makes sense. As we bought more farm ground, we've added more tile to those farming into that farmland, and that value for tiling is going up as well. So when are most capital purchases made? So I've broke these into different 5-year panels, and we look at by quarter. So we got the first quarter is the first section, second quarter, third quarter, and fourth quarter of the year. And then we show total dollars purchased for each of those 5-year sections. So the first section is in light gray is 2004 to 2008. A little bit darker gray is our 2009 to 2013. Our dark black is 2014 to 2018. And then the orange is 2019 to 2020. So the last 2 years. 2021 is not completed yet. We still have fiscal year farms, so I couldn't get a complete accurate picture of that. So I didn't project that in there as well. But if you look at that, you see that the majority of our equipment is being bought in the fourth quarter of the year. And it hasn't always been that way. You can see that that's increased over time, each of those 5-year panels. So that makes me think more and more back to our picture of, are we using equipment more for a cash expense? And to an extent, yes, some of that. People, they're spending their outlay at the end of the year trying to find a used piece of equipment that is on those lots and using those as a cash expense. But you can also see that we're spending the second most probably in the first calendar quarter of the year. Probably after we've sold that grain, we've collected those grain checks, and we've got some things that maybe we've ordered, and that's going to come in the first kind of year so we can kind of understand cash flow and get those going. Typically, the second quarter of the year is going to be our lowest purchase period of the time. So you kind of use this as a guide of when the majority of that's being bought, and kind of maybe this is where a capital purchase budget comes into play and makes it easier for trying to find maybe there's a better time. Maybe that second quarter of the year, can you get a better discount? Maybe, I don't know. It's hard to tell with all the changes in transportation and all the other things and factories. Who knows when the best time to buy equipment, but at least you have an idea when people are buying the equipment in these slides. So finally, let's talk a little bit about financial trends. So we can look at some pieces that we've already remember. We talked about the average farm machinery. So let's also look at others. So this is average farm buildings, and they increased about $7 on average per year. So this is the average farm, and we had $36 an acre in 2003, and then we went up to 2013 at $107. If we go back, we're looking at going back and looking at these slides. We go back to that bonus depreciation. We did have a change in bonus depreciation, and that's where buildings are at. And remember, this is these are 39. I said $36 an acre. It's $36,000 total. These are total values in thousands of dollars. And so you can see that increase. We've had that run up slowly over time, but you can see a lot more has been used in the last couple last couple years in this slide. And a lot of it's due because I have a little bit more bonus depreciation, adding more buildings. But remember that tile. We've been buying more farm ground a little bit over time. So we've been adding tile, and that value has been going up as well. So you see that increase. The biggest increase that we saw, once again, was from 2012 to 2013. And I really think that was that really high year from the drought. And so we had lots of cash we needed to get some expenses. So not only were we buying a lot of equipment, we also bought a lot of grain bins and machine sheds and tile as well. So that's where the big increase was in that year. Also, the other piece of that is going to be the average value of land owned. And Illinois FBFM, we're very conservative with our values. We don't want to run our values up to $20,000 an acre and then next year it goes down. So we're very slow and conservative about that drive up in time. So we started, and this is in millions of dollars. So in 2003, we had $500,000 of farmland owned by the average farmer. And that increased up to 2005. That was when the first really huge increase in farmland values we saw. We don't see it on these farm balance sheets. It went up 25% per acre in 2005, but we were very conservative in increasing those, so it stayed there. And you can see that ran up into 2010 when that value went up to $4,650, and that was $4,650 an acre. And when that year we had $1 million, so you can see that first little jump. We went up $100,000 to $1 million, then we jumped to $1.2 million, then $1.5 million. That was a period of time when the average farmland value per acre was going up 15% a year. So that's why we see those big increases in there. And I think we also had cash when we were buying farm ground as well. Then you look through 2015 to 2020, and you can see those are pretty much steady. They're 1.7 million to 1.9 million. And that's because that land value increase over that period of time was actually a negative 0.2%. So it didn't change much. And that's the same thing we're seeing there. So if there was an increase, it was probably added farmland to the farming operation that we purchased. And then in 2021, we saw a 7% increase in farmland values, and that's the majority of what we saw in that increase. So keep in mind that, the farmland values has been going up. Some of those peaks that we saw in the actual dollar per acre, we didn't necessarily see in the total values because it was conservatively brought up over time, and you can see a more of a gradual effect on our total farmland values. And like I said, the adding in the acres and increasing value has a big impact on that, but you don't see a huge spike and back down like you'd see on the total dollars per acre or the value per acre as over that period of time. So finally, I'm going to talk a little bit about deferred tax. And what is deferred tax? What are you talking about? So it also been known as a contingent tax liability. So there's three types in our balance sheets. We have a current, intermediate, and long-term. So each one of those correspond with a type of asset. So current is typically going to be your grain inventory or your market livestock. Intermediate is going to be your machinery. And then long-term is going to be your land. So when we're talking about this is the taxes if you sell those assets. So these are estimated over time using some baseline rates. So we want to keep it the same. And then with the average Illinois FBFM cooperator. So we look at this and you see the orange line is the current deferred tax liability. And it was a little under $100,000. And that has seen a couple peaks in there. The first run up was in 2008. after we had the run up in prices, so the inventory prices that we had. And then 2012, once again, the higher values of our crop. And then in 2021, we have a lot of crop and a lot of value. So you saw that other peak in that time. So we had almost $325,000 of just current tax liability. So if you retired tomorrow and you had to sell all that, there's $325,000 of tax that would be due at that point. Intermediate, like we said, is mainly machinery. And you can see what that's done over time. Those kind of aligns with those graphs that we saw the value going up, because we want the values to show, not the tax rates changing. And then long-term is going to be our land. You can see that those graphs kind of follow what we showed you before with the different pieces. When you look at it a different way, now we collapse and put it all together. And we started at a total deferred tax liability in 2003 at $220,000. And that's increased over time. In 2006 and 7, that went up to about $380,000. And then you move on to 2012. That's that first little peak that we saw in here. We were at $707,000 of deferred tax liability. So if we had to sell out tomorrow, lock, stock, and barrel, we have over $700,000 of tax. That stayed up there to 2014. Remember, that was our high machinery value year. That went up to 756. And then we leveled off, long-term assets or intermediate assets stayed about the same. Our current liability stayed the same. And then we saw the peaks up since 2019. And now our total for 2021 was almost $880,000 in 2021 when you combine all those, especially with that increase in that current. We saw our machinery values go up. We saw our land values go up. So all those pieces add up to a deferred tax liability if you sold all of those assets. And if you look at that over the grand scheme of this, it's about a third per asset type. So if you have to sell out your current assets, you're going to have a third of that total. So 800,000 of that, third of 800,000 is going to be just for the current portion. You may hold on to your machinery and your land. And so those are deferred taxes for another day. So what are you telling me with that? So let's look at what the percent of your net worth is needed for deferred tax. On this graph, we kind of skewed it down and looked at 22% to 28% because that's where it's been over that period of time. And 1% in this graph on the average 2021 farm is about $37,500. So keep that in mind, that it's a huge swing as 1%. So we had a higher level in 2003, about 24.9%. We saw our highest level in 2008 at 27.3%. And then that's kind of leveled off all the way down to 2021 at 23.2%. Well, this graph's opposite of everything we've seen. Everything else has gone up. Well, we have to think about there's two driving factors in there, right? Net worth and then the tax rates. So if our values are going up, so our balance sheet's going up, those asset values are going up, our net worth is increasing, but those tax levels aren't increasing at the same rate. So that's why we see that coming down. But still, 23% of your total net worth is have to go to tax if you sold everything out is something to keep in mind. 23%, I told you. So if we said that's 24%, so it's about 8% of your net worth would be due if you had to sell out all your current inventory, or if you had to sell all your machinery or had to sell all your land. So 8% for each one of those gets you to 24% for that total. So with that, I wanted to make sure all this data that came there comes from Illinois FBFM Association. We have about 5,000 farms, which represents about 12,000 farm families. And we have a 20 professional field staff that work one-on-one with those cooperatives throughout the year. So without them, it would be hard to do all these pieces and have this good information to share with you. 70 professional staff. Key points to remember out of all this information, there are lots of slides, lots of graphs. Machinery values are going to continue to rise. How long at the rate that we've seen it? It's hard to tell. Supply and demand. Higher tax liabilities, higher farm incomes. We're still going to have good high farm incomes for next year or for 2022. And our IRS tools have led to use of machinery as a cash expense. Is that going to continue? We need to do that more and do a capital budget instead of focusing on just fixing our tax liability. Keep in mind that about 30% of our purchases are done in the fourth quarter of the year, and they're primarily tractors and field tile are what we spend the most money on. And finally, make sure you monitor your deferred tax. You may never have to pay it, but make sure you're paying attention, especially when you're nearing retirement. It averages about 25% of your net worth, and it's about a third of each one of your asset types. So if you're going to retire, you're probably going to sell out your inventory and your machinery. So right there, you're looking at 2/3 of that. So you might be 12% of your net worth that's got to go to Uncle Sam when you sell out those pieces. So manage your tax liabilities as you go along, and maybe you can lessen that and move that over a period of time and not have to pay that big tax liability all in 1 year. So with that, I'm going to go and look and see if there's any questions.
Yeah, we'll check and see if there are questions. And if you've got questions for Brad Zwilling, you can put those in the box in the main space as you're typing those in. If you've got questions, a reminder that there are some upcoming webinars in this series. You're already signed up for them because you're on the webinar of the day. Next week, we'll be talking about the Young Farmers Program with Krista Swanson and Nick Paulson. And there may be one left to do on the 27th. And then on November the 21st, the Farm Assets Conference is taking place. That's here at the iHotel on the Urbana-Champaign campus, just south of the State Farm Center. We'll have more details of that on the FarmDoc Daily website at willag.org as well. Some sponsors to make sure that we mention for the day: the Illinois FBFM, Farm Business Farm Management Association, of course, is always involved with the agricultural economist here on the Urbana-Champaign campus, making sure that the aggregated data that comes from it is able to feed into what the economists are developing for farmers and others and agriculture across the state and the nation. Illinois Extension, of course, is part and parcel of that, as is the College of Agricultural, Consumer, and Environmental Sciences and the Department of Agricultural and Consumer Economics. FarmDoc sponsors include TIAA, the Center for Farmland Research. You can find them online at farmland.illinois.edu. Compeer Financial, Corteva Agriscience, Farm Credit Illinois, the Illinois Soybean Association, the Illinois Corn Growers Association, FS Growmark, and the Gardner Agricultural Policy Program. As I told you up front, there are a couple of ways that you can get hold of our programming after the fact. You can do that, of course, by visiting farmdocdaily.illinois.edu. You can see this particular program again under the archives in the webinar section. So farmdocdaily.illinois.edu. And then webinar, or if you want to go directly to see it, you can visit youtube.com/farmdocvideo. That's down there on the bottom right-hand side of the screen. We have a series of questions that have come in. I take it, Brad, that you probably had a chance to read through them. What is there to answer today?
Yeah. So first question, can you talk about how operators are financing those equipment purchases? Example, paying cash or opting for term notes. I think it's dependent on the years that they were there. The years they had a lot of cash, they were spending a lot of cash for those. But then I did see some people going back and terming those out after we made those purchases, maybe in 2012 and 13. And then when we had lower incomes, they may want to went back and did that. So I think over the time, I think that we've saw a good mixture of all those. I don't have a good handle of which is the majority of those. But I think moving forward, I think a lot of them are opting for term notes, especially with all the volatility and risk out there. But it also depends on each individual situation. What does your financial picture look like? How much debt can you take on? Maybe you don't have a lot of cash available, so you're financing it, but paying it down fairly quickly. So the good question.
And I believe there's a follow-up to that question.
Yeah. And then, so a good question. It says, what you saw in finance purchase in 2020 are different, if they are, than what you're seeing in 2022, and how's the rising interest rates impacting purchasing trends? I think we saw a lot of purchases happen in 2021, and probably some of those were financed. I haven't looked at all those pieces to know that, but we saw a lot of that because we hadn't bought a lot of equipment. As you saw, we hadn't bought a lot of equipment because we bought quite a bit of equipment in 2012, 13, 14. So as you're going through a replacement cycle, that's when we happened to go ahead and then for years now, we finally replaced some of those in 2021. So in 2022, I think we're going to still do some things that have to be replaced. And I think that, but we're not going to do a lot of them unless we're needed. And you're right, interest rates are going to have a big impact on those purchasing trends, especially at the end of the year. I said that most of the equipment's bought at the last quarter of the year. Well, rates are up a lot. Maybe if the first part of the year, you might have bought more than what you now at the end of the year. So that's going to kind of make you think twice. And that's where I think that capital budgeting is going to come in. Another question. What effect did the wide distribution of stimulus money during and after COVID have on machinery purchases? That's a good question. Don't have I have an idea of what was there. I think that allowed a lot of cash in the farmers' hands. That was either to help pay down debt or get them in a good situation, or some of them use it for a tax deduction if they needed to buy some equipment. It wasn't necessarily all the same for everyone. A lot of farmers need that, especially the livestock farmers use that to supplement some of their cash flow at that period of time. But once the crop was harvested and we had values there, we were able to use some of that cash to do some of that to buy some equipment. But when we looked at those income years, we had some really, really low income years from that 2015 to 2019. You adjust those for inflation, that's one of the second lowest 5-year panels that we've had over the period of time. So it looked very bleak with 2020 and the COVID money that came through. So a lot of farmers needed that, not knowing the uncertainty of what might happen. So great question. One more question. Following the pattern of purchasing the fourth quarter of the year versus the first quarter, are you seeing any shifts in operators taking the cash from new crop sales now in quarter four and rather than Q1? There's long been a tax strategy where farmers deferred payments to Q1. I've not seen a change in that. I think what a lot of them are doing now is doing deferred payments, and then you can make an election out of that and count that income in the fourth quarter of the year or in the current year, or move it to next year, depending on what election you make with using a deferred payment. So I haven't seen a lot of that. We don't collect a lot of the information, but I think you're right. I think some of them, depending on the pricing strategy, they've marketed a lot of grain for January 1. And so they're taking the money probably January 1, but maybe counting it for taxable income in the current year, and then maybe need a tax deduction. All right. Thank you.
You've been watching, of course, the Fall Farm Doc webinar series. This is number 5 of the series. You can find them all online at youtube.com/farmdoc video or farmdocdaily.illinois.edu. Look under webinars and in the archive. Our thanks go to Brad Zwilling for the presentation today about machinery investments and farm financial trends. He's the Vice President of Data Analysis at Illinois FBFM, the Farm Business Farm Management Services. Behind the scenes, our thanks go to Jim Baltz. He'll make sure that everything gets posted to the website and looks really pretty as we make our way through each and every one of those webinars. Jim, thank you for doing that so very much. I'm University of Illinois Extension's Todd Gleason, wishing you a good day.